Good morning, viewers. Welcome to the third quarter's Global Listed Property Dashboard. I'm Binette Gasson, CRO at Catalyst Fund Managers, and this morning I'm joined by Lance Besaidenoort, Senior Investment Analyst of our Catalyst Global Real Estate UCITS Fund. Lance, let's get right into it. In our portfolio construction, you guys are quite bullish on data centers, and I think it's for very obvious reasons. We've seen crazy demand from your big tech giants, right? Amazon, Microsoft, Google. And the demand has been driven by the fact that everyone's investing in their digital infrastructure and everyone's focusing on cloud computing. And obviously, this whole craziness around artificial intelligence or just AI has obviously just catapulted. So we've touched on the demand side, but what does supply actually look like?
Yes, certainly, Binette. So, it's a constantly evolving landscape and space to be in. As you mentioned, demand's phenomenally strong. So we have no issue or hiccups on the demand side. On the supply side, supply levels, if you look at development, it can be upwards of 20% of inventory growth per year, which for real estate investors, that lets the hair on your back stand up a bit when you look at numbers like that, where you're more accustomed to maybe 2 or 3%, 4% supply levels in the general space, right? So it's quite an eye-popping number, but it's sort of in lockstep with the demand, and it's actually, if one's going to really try and balance it off, it's not enough to meet the demand. And that's evidenced by, in North America, vacancy levels approaching the 1% level. So for all intents and purposes, frictional vacancy levels. So supply is elevated, absorption is more than supply, leading to vacancy rates being at record lows.
It's always good to have a full take on what the fundamentals are looking like. And within data centers, you guys have your certain counters that you prefer, and we know that one's Digital Realty. The big favorite has been for a long time Equinix. So what is it about Equinix that, in your opinion, gives it its competitive edge in the market?
Yeah, so I think the two companies we really have covered for a long time are Digital Realty, which focuses on hyperscale tenants, which are your larger footprint tenants, and Equinix, which has historically been interconnection, retail, co-location business, which focuses on smaller footprints, more tenants, more dense networks, even though they have recently been going a bit more into hyperscale and playing that sometimes through JV structures. So the two differentiating factors for me is the global scale and the interconnection. So on the scale side, about 2/3 of the customers are Forbes 500 customers, so really good credit quality, and 90% of all customers have multi-region deployment. So what that means, when you have this global platform consisting of hundreds of thousands of cross connects, connecting tenants with their own servers and with other servers on existing campuses, locally and cross-border, creates this magnetic environment where it's very difficult for you to separate from that, and the switching costs are very high. So we think that is incredibly valuable, and they're the leading company to monetize that.
It's always fascinating, you listen to the fundamentals like we alluded to earlier that sound quite strong. You listen to Equinix and this big portion of the market that it's been able to capture. But yet, if we look year to date and just like the last month of September, there's been underperformance in the sector. So can you unpack that for us and share with us some of the key drivers of that underperformance?
So it's exactly that. Fundamentals have never been stronger. It's really record levels of demand, record low vacancies. One would naturally and logically expect that to translate into earnings growth, which it has, which should be rewarded by share price returns, which it hasn't. I think just maybe where we are quite different, we're obviously long-term investors in the real estate space. We're happy to wait out multi-years to realize a value or intrinsic value that we see in a stock. Whereas, to paint an example of the psyche of the investor in today's market, we've been in conference meetings this year where we've had analysts from Wall Street asking company management teams, since we met last week, what has changed about the business? So, that is starkly different to what we look at. We would never look to invest on a short-term basis of even a year or two, let alone a weekly basis. So in those sort of environments, we're going to be placing a different level of value on certain attributes or aspects of a company than what a general investor would with that sort of mindset. Parking that, a lot of that underperformance that came was following the analyst day, where they pretty much, I mean, they're at the coal face of this massive wave of demand, right? And they want to monetize this, and they realize it's an opportunity that could be fleeting. And the reason for that is that the gating item is power availability. So you need to procure power to power these data centers. They're very power hungry. And it's on the generation as well as on the transmission side, and arguably more so on the transmission side where the bottleneck exists. So they have managed to procure a lot of that power. They've upped their capex target through 2029 to 4 to 5 billion of development per year. So they want to deploy that existing capacity, as well as secure that scarce power availability that's existing in the market today and deploy that further before it becomes too much of a limitation to develop out. So for us, I mean, after that announcement, I ran the numbers, and the value we saw in the stock was materially higher. But the ensuing 1 or 2 days afterwards, the stock was down close to 20%. So that sort of, once again, highlights the different mindset of the investor versus a long-term investor, where we're prepared to wait it out for that to be accretive, which it will be, or it should be over time. Whereas initially there might be a 1 to 3 year period where, you know, there's a bit of earnings dilution as these developments come on. There's interest headwind from funding the development. And then when it ramps, ultimately you get rewarded. But a lot of the investors that are punishing the share price aren't prepared to wait for that.
So in your opinion, like you alluded to, that Equinix has been, you know, investing quite aggressively. And obviously there's this like mismatch between short-term and long-term views. But how do you see this like capital injector paying off in the long term?
So, I mean, I'm going to throw some metrics at you, but so it's 4 to 5 billion a year of development spend. I mean, they're able to realize at least 10 to 12% stabilized development yields over a 3 to 5 year period, right? So it takes some time, but it gets a very attractive return. That can revalue to a mid 5 to 6% cap rate. So you can, in instances, have margins approaching 100% on development. And more so, they're funding that at costs of debt of 5% or below. In certain jurisdictions, they can fund it at 2 to 3% interest cost. So the spread is massive. So you can see how that drops down to the bottom line. So, I mean, obviously, you throw that all in a mixer, it creates a lot of value. We are prepared to wait for that value creation. Like I said, short-term investors less so. I mean, also what that drives through 2029 is 7 to 10% revenue growth. And then there's also a reasonable margin glide path from a current 49% levels on margins to 52% and above. So all those things are very positive factors that we like. And yeah, I think it's just near term, you know, you probably have that 5 to 9% AFFO or cash earnings growth per year as it ramps and you have those interest headwinds. But underlying that's 8 to 11% earnings growth. So you have to look through that, which we're prepared to do.
Lance, if we do a relative play to moving to the relative speaking to from global listed property to general equities, and we turn to the S&P 500, how do you think this whole investment case differs or is similar to some of the big tech stocks? Everyone knows about Mag 7, but how do you think the investment case is similar or maybe different, focusing on in that space?
So, I mean, it's a great contrast. And I mean, obviously, we've been on that back end of the receiving end of, you know, flows finding its way into Mag 7 at the expense of the real estate equivalents. I mean, the Mag 7, like you say, it's at any point in time, it fluctuates, but it constitutes at least a third of the S&P 500 market cap as of today. And it's what's really driven the performance. So, you know, the performance realized there is through those sort of companies. I think your top 10 stocks is closer to 40% of the S&P 500. So it also represents a massive amount of concentration risk. And while arguably, with a company like Equinix, it's the picks and shovels approach to align yourself with the AI thematic. We aren't really a thematic investor, we're more bottom up fundamentals, but it ticks that box as well for investors. So it's similar demand drivers, and you can sort of get on the same train but go to different destinations for an analogy. Effectively, we think because the data center space and Equinix in particular hasn't performed strongly at a share price level, whereas these Mag 7s have, it's a very appropriate way to get exposure to that space. You don't want to be chasing these winners for too long, because there's definitely, as you do that, there's more downside risk that develops. Whereas we believe downside risk is quite limited in a stock like Equinix, because their earnings growth is underpinned by contractual leases with tenants. Those hyperscalers that you're bidding up on the Mag 7 side are the ones that are taking space with Equinix. There's pre-leasing on that development. So there's a lot more downside protection. So it's a bit more of in our mind, a better risk-adjusted way to gain exposure to the space.
Lance, it's so tricky, and I don't envy your position often. Like, given this macro backdrop where fundamentals are super strong, there's the short-term, long-term play constantly. How are you positioned, like, from a conviction point of view? Have you tapered back from your conviction? Are you even more bullish on your conviction on data centers? Like, how are you thinking about it?
Yeah, so obviously we always take a balanced approach. We want to be mindful of the risks, right? And it's a lot easier to underwrite those risks when, like I've said, the shares underperformed off the back of record fundamentals, right? So we are more bullish on the stock than we were before. We have a higher conviction. We've really scratched deeply, like not just on the surface. And like I said, after the analyst day, we revised our assumptions. We saw material more upside to the valuation than before that announcement. So we think it's the right strategy. We're prepared to sort of double down on it, and we have been topping up on the name as this unwarranted weakness in the name continues. I'd say, you don't want to drink the Kool-Aid, but over the next few years, pre-leasing is going to be at exceptionally high levels, right? Maybe you have a similar scenario, whereas in the industrial space, you have an Amazon that's really driving the bus on demand, and then they start scaling back in terms of the space requirements. We don't see that. We see, if anything, over the next few years, the hyperscalers ramping up their capex investment. But even capturing a fragment of that, it's enough to really drive that earnings growth profile. So we are higher convicted on it. We have increased our positioning in the stock. And we think it's a really good risk-adjusted proposition.
Okay. Lance, it's been very insightful. And I have to ask, last but not least, what's your outlook for the global listed property sector?
Yeah, so the deep dive has really been on Equinix, because that's where the performance versus the earnings prospects, have diverged the most. But in terms of the overall global listed real estate space, it's also probably hasn't performed as strongly as we would have expected. But we expect, with fundamental cadence driving revenue growth over time, it will close the gap to, the equity performance. Effectively, as a whole, we see the sector delivering 5% cash earnings yield, forward cash earnings yield over the next 12 months, and we expect that to grow by 5% a year for the next 4 to 5 years. So you're getting a double-digit return in a stable interest rate environment, so not underwriting rates coming down further, even though the Fed has seemingly commenced its cutting path. That's absent any re-rating in the space. And to the extent you get rates continue to come down, you really get this attenuation in the interest finance headwind. So that has been a headwind and probably over-penalized by the market in terms of their perception of how that affects a REIT's interest costs, which actually the profile's a lot more staggered than people think, so it's a lot more manageable. But to the extent that comes down, the actual headwind as well as the perceived headwind, that perception will improve, and that will drive further earnings and potentially a re-rating in the space as well. But absent that, just on what we can see over the next 1 to 3 years in terms of what's contracted, what leases are expiring, what's going to be captured, which is quite certain. We see a double-digit return, which in US dollars we think is quite compelling.
Lance, thank you so much for your time. Viewers, I don't think a double-digit return sounds too bad. With fundamentals looking quite strong, I think it
In US dollars.
In US dollars, and relatively speaking, it is looking quite cheap, quite attractive in comparison to other asset classes. Thank you so much for tuning in. If you'd like to learn more, please refer to the full Q3 Global Dashboard, or alternatively, please reach out to me as per the contact details below. Thank you and goodbye.